Hey everybody, welcome back to the Investing Podcast. I'm Garrett Palmer, joined here with Ben Nye. I'm a late fill-in for Andrew, who usually hosts. He's at Disney World, right? And man, that'd be a really good segue into a Disney video, but we're actually going to be talking about Nike today. And to an amateur like me, when they first reported last night, after market close yesterday. To an amateur like me, it looks pretty good. So they report earnings of 57 cents per share versus estimates of 48 cents. And they did miss revenue by about $20 million, but that's not much when you're talking about actually coming in at $9 billion. So pretty small miss there. Ben, tell us about why the stock ended up trading down despite it looking like pretty good news.
Yeah, unfortunately, it's a bit more of the same for Nike. So the problem Nike's having is on many fronts. On the one front, the athleisure segment is slowing down. And on the second front, Adidas is taking significant share. So what you're seeing at Nike is price cutting. You're seeing discounts that we've never seen with Nike before. You're seeing a North American market that's actually expected to contract next quarter, and gross margin that's continually under pressure between 150 and 200 basis points year over year. Now, it's tempting to say this is not Nike's fault, this is the fault of the market, but that's not entirely true. If you look at the revenue for Adidas, for instance, Adidas revenue going from 2015 through 2018, expected in 2018, all the others are actual. Adidas has gone from negative 3% to 1% to 1% and is now in 2018 expected to do 2% revenue growth. Nike, on the other hand, has gone 3, 0, negative 3, negative 2. And I think that negative 2 might actually be high. I wouldn't be surprised if it hits negative 3 this year as well. So Nike's dealing with that. On the revenue side, they're also dealing with significant gross margin compression. We've lost about 220 basis points of gross margin, and that's expected through 2018. Again, Nike keeps coming out and saying that gross margin is going to stabilize a little bit more, but then the next following quarter, they say, actually, it's not really stabilizing yet. And you're talking about a Nike gross margin that's 43.8% versus an Adidas gross margin that's 49.8%.
Wow. I will say in my personal experience, I mean, a few years ago, there was a ton of hype around the athleisure stuff coming out and stuff with your team and, sayings or whatever. And I will say that I have seen that excitement drop quite a bit over the past few years. So it doesn't really surprise me that the North American is slowing down to such a degree. Do you think that with this news that today's roughly 4% price drop is justified?
I think it's justified, and I'm concerned that they didn't drop the bar enough. I think that what Nike needs to do is almost say, okay, we're completely retooling our strategy. We are really looking to innovate. They have all these buzzwords like elevate to innovate, things like that. And things like that just haven't been working. At the end of the day, they're still a shoe company that still tries to make new shoes. They still rely in large part on those sponsorships, which were a tremendous innovation and really genius marketing when they first came out. But the market has moved beyond that. They need a new marketing strategy, and I'm not sure what that is. If I was sure what that is, I'd be working for them and making a lot more than I am doing this podcast. But the fact of the matter is they need to retool on marketing. They need to really improve that cost structure. They went to this kind of robotic, automated manufacturing process for the Flyknits, but the margin keeps coming down. We don't want to see that margin compression. And this margin compression is particularly surprising because they keep boasting about how well direct selling is. If you take out the middleman, you should be able to make more money yourself. So Nike is also having issues on that regard. Now, I was a bull on Nike. I have been a bull on Nike. I should have been selling after their last earnings report, which I felt was given more of the benefit of the doubt than it perhaps should have been. I didn't. But now going forward, I think that we're in a big transitional period for Nike, and something that's probably going underestimated by, if not the market, then certainly the management team.
All right, that's Nike, and full disclosure, we do own it for clients, and we'll continue to keep our eye on it moving forward. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.